What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is May 18th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, I not only want to spend some time to talk about Bitcoin's continued strength as we're seeing it yet again try to get above the big even level of $10,000, but along with that, talk about the resilience and strength we've seen in precious metals markets for both gold and silver. And my major point overall is that this is not simply pure coincidence. The market is pricing something in. And we have to look no further than bank stocks to realize that it's the future actions of the Fed that the market is starting to account for. We'll talk about that and more as we go throughout the video right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. Bitpanda Pro is the secure European exchange for crypto to fiat markets. Bitpanda has been offering secure, straightforward, and easy access to the cryptocurrency market in Europe for over 5 years and wants to offer the same service to more experienced traders, users using trading bots, and other advanced clients like cryptocurrency businesses and institutional investors. With the steady addition of more and more crypto to fiat trading pairs, Bitpanda Pro has made itself a convenient, secure, and trustworthy exchange to onboard or cash out easily. Check out the link down below in the description to learn more. Alrighty, everyone, so as we take a look across the board here for cryptocurrency markets to start, we can see the vast majority of cryptocurrencies are in negative territory. However, most of them are in a no trend scenario at the moment, between 1% to 2% to the upside or downside. As over the last few days, over the weekend, crypto markets were actually doing quite positive. We not only had a lot of altcoins gaining to a decent degree, but Bitcoin as well, holding up and pressing up above that big even level of $10,000 as we alluded to at the beginning of the video. And again, continuously showcasing that the bulls are currently maintaining the trend here, that there is optimism throughout the market. Now, I do want to let you all know real quick, just as I always like to let you guys know with conferences, I'm actually going to be speaking at the next Blockdown 2020 virtual conference. It's going to be hosted from June 18th to the 19th. You can find details on the website as well as the different ticket packages. There's a free ticket, a business ticket, and a VIP ticket that you can go through. So definitely check that out if you guys are interested in possibly attending to that. But I'd really love to see you guys there. It's an awesome 3D virtual conference. But anyways, there's going to be a giveaway as well in the description. So if you guys want to enter in for a chance to win on that, we get some free tickets we're going to be giving away too down below in the Google form in the description. So fill that out if you'd like to be entered in for that. All right, so let's go ahead and first talk about Bitcoin here. The thesis that we've had over the last few weeks has continued to maintain here as Bitcoin is pressing up very consistently against resistance, more than it has in the previous two times, because if we take a look at the last few peaks, usually we set a high and then we start to set lower weekly highs as we saw over here and here. And then also over here, we never set a higher level when we tested this line of resistance. We definitely did test it a few times. But over here, we're consistently holding around a similar range here if we take a look at price. Jumping down to the daily, we can see even a more clear picture here that, again, all we're looking for is really a volume breakout here to the upside. One solid range of a few major institutional and large players buying into Bitcoin here and pressing prices up above the $10,000 range. Because when that happens, I think we're going all the way to 11,200, testing this line of both support and resistance in the past. And then what we're going to do is like we did on gold markets, as we had a breakout of the wedge that was really set up over multiple years since the previous peak in 2011, and then we came down to rest on it as support. We're going to do the exact same thing that gold did, in my opinion, here, looking at the chart and the resilience and strength that we had post-halving event, right? We had buyers come in around this key support level, and now prices are riding higher. So not much has changed in that sense. It's looking exactly like it's doing what we need it to do in this case. Volume coming in very strong here compared to the past few weeks back down here. Buyers getting eager as we've gone into a post-halving world and as the supply is starting to become more tightened for Bitcoin. But this isn't all that I want to talk about. What I really want to dive into is the current financial sector and talk about the current status of financial equities. You know, as we're going to talk about, we have had resilience and strength in Bitcoin, but we've also had it in gold and silver. But it's also important to look at where the weakness is right now to see if there's any signs that are going on in other markets. And we have to look no further than the financial sector to get a picture of this. Now, I know what you all are thinking. Nick, how can the financial sector be doing bad? The government's literally handing them money. They're printing money like crazy. They're lowering interest rates. What's the deal here? Why are banks not doing well? And I'll be honest and just be straightforward with you all. It has a lot to do with that second point, interest rates. And what may shock many of you is that negative interest rates are actually not a good sign for commercial banks. So we'll talk about this in a minute. So we can take a look here at the SPF. This is a broad index for the S&P 500 financials. And compared to a lot of equities right now, which not only rebounded much higher if you look at the broader S&P 500, the Dow Jones, especially the NASDAQ, and if you were to look at the FANG stocks, the big tech stocks, they're back up to their all-time highs. But we can see here the S&P 500 Financials Index is actually showing us a very clear multi-week dead cat bounce, where valuations started to set consistent highs here, and then we started to set lower highs and lower lows, signaling that bears are starting to take over here, that price action is not in a bullish favor. We can take a look on the weekly as well, and that's still very consistent with the trend we're seeing on the daily. So what's going on here? What's going on in the broader financial sector when stocks like JP Morgan, right, that have been leading the market are rolling over again, going down about 15% from the relative highs here in April? We can take a look as well at Bank of America, similar trend here, rolling back over again after a double top here. You can look across the board on a lot of commercial banks, but we need not look further than the Euro stocks, right? We're going to go ahead and take a look at the Euro. Actually, we'll look at Euro banks real quick. Sorry, FESB futures here. They give us a good broad index view of the current status of European financial banks. So let's just go ahead and take a look here since all the way back here in 2007. As many of you may know, or some of you might not know as well, it's completely fine, European stocks never really recovered from back in 2008, as they had a broad collapse, as many of the broader financial sector had a collapse. We never really saw a recovery in the broader banking sector for European financial banks. There's a reason for this, because over the last couple of years, Europe has been one of the first candidates to test around with the implementation of negative interest rates. Now, many of you are wondering, why are negative interest rates per se bad for the financial sector, right? It is true that if there's negative interest rates, you're paying the bank, or you're basically paying a fee, basically a maintenance fee at the end of the day, if you want to see it like that, to hold your funds. Yes, banks make that kind of money. But with lower interest rates, this means that in this case, when they're doing lending operations, that interest rates are not as favorable for them, right? They are basically lending out to you in this case at probably near 0% interest, or very, very low interest rates comparative to the standard rates they would do, right? So I'd say actually probably 0% interest. To take that back, it's probably an exaggeration. They're still probably going to charge you something like, it depends on really what the loan is. In this case, it could vary if it's a home mortgage. Home mortgages are very competitive. Credit card debt, on the other hand, it could be varied, but depending on, who they're really lending it out to. So they could still make some margins there. But overall, the compression of interest rates in a negative territory is used as a mechanism to stimulate the underlying economy in bad times in order to create artificial stimulus, because they're basically bringing it to rates where you're almost getting paid to borrow. And along with that, it brings down the profit margins of banks in this case, even though you are having to pay a little bit for them to hold your money. So we can already see that reflected here in European stocks. Investors are not interested in negative interest rates, but I think that's exactly what we're seeing here in the broader S&P 500 financials, because the Fed is getting very, very close to this. Taking a look here at the current Fed funds rate, we are already at around 0 to 0.25%. This is the variable range that the Fed funds rate can go to, and we've already had some days where we're down to 0.10, some days we're up to 0.15, fractional single digits, 0.07 or 0.08. So this basically means that interest rates are practically speaking around 0%. Let's just keep it simple. What was one step away from being negative? It's one Fed funds rate cut from being in historic territory, where for the first time in the United States, alongside the European Central Bank, the ECB, and also the Bank of Japan, BOJ, entering into negative territory, where it will not cost anyone to borrow anything from the Fed. In fact, they'll pay you. Interesting stuff. So what happens in this changing dynamic here, right? When negative interest rates become a reality, something that literally just a year ago sounded like a fairy tale for the United States. It was impossible. But now in a post-COVID world, it doesn't seem so crazy. Well, there's a few things that are going to happen. First off, Treasury yields are going to drop like a rock, because if the Fed is providing guaranteed liquidity and they're basically telling you you can borrow it for not only free, but you'll get paid to borrow it, well, people are going to basically go out, buy up US treasuries that have a guaranteed yield until the point where it goes down to zero, and in fact, it starts to go into negative territory. Because if they can borrow up the capital in this case and have a guaranteed liquidity stream in order to buy assets like treasuries, right, the world-renowned safe asset that's used in things like the Sharpe ratio, well, now it's going to start going into negative territory. Now, the bond might be going up in value, especially for traders and speculators. This is good, but not for long-term holders who have treasuries who are going to be holding it for the next 10, 20, 30, 40 years into retirement. They're going to be left with the empty bags, taking on all the negative penalties of the negative yield, while also having the bonds correct in the long term down to much more fair valuation, ending the bond bubble that we're currently in. So this is going to go down into negative territory. That's bad news for long-term holders. This is an example of the U.S. 2-year yield as well as the U.S. 6-month yield, both of which not only have tested, in this case, the 6-month has already tested into negative territory. We had that back during the peak of the fear back in March. But it looks very close to rolling back down to that. And the 2-year yield has been a consistent weekly downtrend here, down into possible negative territory soon. But you take a look broadly in regards to the Treasury yields here, and you can see, I know it seems boring, guys, but the ramifications of this going down to these kind of yields is astronomical. We're talking about one of the largest, safest markets in the world, multi-trillion-dollar market here that is possibly going to be entering into a zone that it's never been in, which is negative interest rates, which is, in this case, negative yields. So it's going to have an effect on treasury markets. It's going to have an effect on deposit accounts. Why is it that right now we're seeing gold and silver performing absolutely stellar in their sense of their price? Silver going from around $15.31 per ounce in the last 3 days all the way up to a peak here of around $17.62. And gold rallying to relative highs that we haven't seen all the way back since 2012. Why is this? Why is it that these assets are performing well? Well, it's because that even though gold and silver, as well as Bitcoin, don't provide a yield, they don't penalize you for holding it. And along with that, they can't be printed into oblivion. They are completely separate. I'm trying to make sure I word this properly. To put it in very simple terms, they're completely separate from the existing system. There is no central bank of gold. There is no central bank of silver or Bitcoin. There is no tie to a specific national economy with these commodities or this cryptocurrency. They are completely separate. And this benefit of being completely separate, completely, basically immune to central bank manipulation, negative effects and ramifications of negative interest rates, as well as excessive printing. This makes them a perfect asset. And one last thing to just top it off here. As you all know, I like to look at ratios. The gold to silver ratio is probably the most important ratio to look at when you're trying to determine when we're entering into bull markets for commodities. And when it's declining after a new set of highs, that's usually a time when we're into the next cycle. And take a look at what it's been doing. Weeks here since back here in March, where silver has started to gain to gold. Where have we seen this before? Back here in 2008. This is why, after multiple years, guys, I've made it very, very clear since back in 2018, I started to take the position here that I was bearish on equities. The central bank game was over. It's just a matter of time. And now equities have started to correct with what happened with COVID. Sure, it's rebounding a bit here, right? And sure, maybe you could be up on your money with equities, no doubt. I've got a little bit of position myself. But what markets are really winning in this environment? It doesn't matter if you're up 5 or 10%. Anyone can be up 5 or 10% in an economy where central banks are printing a new wave of monetary policy that we have yet to see throughout our history, where dollars and liquidity are cheap, easy to access. What markets are performing in double-digit territory? Which markets are leading the way? Which ones are the horse that are winning in the race? It's gold, silver, and above all, it's Bitcoin. As Paul Tudor Jones said just a couple of weeks ago, it's the fastest horse in the race. And as much as I think many people believe and hope, I think many people, including myself, were expecting that we might have a chance to see Bitcoin down here in the $7,000 to $7,500 range, I really don't think we're going to get that. Because the race has already started. The Fed was the gatekeeper. They started the race. And now it's just a matter of these assets reacting to how far central banks are really willing to go in their efforts to print money and lower interest rates. I would put my money to it that by possibly the end of this year, in 2020, we see for the first time in the United States, alongside Europe and Japan, negative interest rates. And it will, as much as it scares me, it will be fascinating to watch what happens in a world of negative interest rates in the United States. We'll have to see. I think the Fed's going to have to do it. They've stated multiple times that they're not going to, but we'll have to see. What do you guys think about it? Do you agree with me in this case that the Fed is possibly going to lower negative interest rates? I know many people make the argument that it wouldn't be beneficial for banking stocks and therefore they wouldn't do it. It's been happening in Europe for the last near decade. So I'm interested to hear your thoughts on the issue. It's not just my opinion that matters, it's all of our opinions that matter, and we can come together and learn from one another. All right. Anyways, that's it for the video. Thank you all so much for watching. I hope you all are having a fantastic day wherever you are, and I'll see you all in the next video. Stay tuned.